Hello and welcome to the deVere live webinar series. This is our first webinar of 2021 and our first webinar in the year of the ox, and it's titled Grabbing the Year of the Ox by the Horns. An exciting webinar today, and really it's focusing very much on this year and what happened last year, what happened in the year of the rats, what happened in 2020. A year that will go down in history for sure, and for many of us a very difficult year. So what we really wanted to do today was to focus on what happened last year, but not so much on the negatives, more about what did we learn. Any negative situation or any bad situation, we can look at it and say, okay, what did we learn from that situation to make sure that we're better protected in the future, and going forward we can be in a better situation. So that's what we want to focus on today, and really it's going to be about protection. So today we're joined by three protection experts. We have Ricardo Lugo from deVere, who's going to be talking about medical insurance. We have Armando Flores Chiu from deVere China, talking about an emergency fund and financial protection in case of emergency. And we have Richard Le-Gallez from RL360 talking about life insurance. So what each of those three presenters will do is they will do a short presentation. And what will happen hopefully during that presentation is that you'll have some questions for them at the end, because we'll have a 10 to 15 minute quick Q&A at the end of the webinar that you'll be able to participate in. So you should be able to see, if you're new to Zoom or new to webinars, you should be able to see a Q&A box. So in there, just put in your question, and what I'll do at the end of the webinar is I'll ask those questions to the presenters, and we'll get some more information from them. And if you want more information, if it sparked any interest in whatever any of these presenters do today, we'll also give you the option to actually reach out and get more information at the end of the webinar as well. So hold on for that. So Ricardo, if you just want to share your screen, and you can start with that. And I will, there he is. Ricardo works at deVere, an insurance brokerage focused in Asia, with offices in Hong Kong, Singapore, Shanghai, and Beijing. Ricardo's in Shanghai with us. As an insurance advisor for both individuals and companies, he works together with his clients to offer comparisons of different options and guidance to find the most appropriate plan for their needs. He is an excellent broker, and I can speak from personal experience. He helped me out with my medical insurance, so he knows what he's talking about. And with that, over to you, Ricardo.
Yes, so you can see my screen well, right?
Yes, we can see it fine.
Okay, perfect. So thank you, Will, for the introduction. As you mentioned, I will be talking about medical insurance, what happened last year, and how we can use that to be better protected for next year. So I think if there's anything that we've all learned this past year, is just how important medical insurance is in our lives. Unfortunate cases can happen to anyone, anywhere. So why is it especially important when you are living abroad? Because many of us, such as you or me, we back home, we can rely on the social security, but here in China, national healthcare system is not really well suited for us, because it doesn't offer us the coverage that we really need in case something bad will happen, right? So another important reason is that the medical expenses can be very high. For minor things, it can be easily above $200 or so, but for major illnesses or a big surgery, it can easily surpass the hundreds of thousands of RMB, and it can just be really taxing in our financial side. So and then the last point, obviously some of us already are covered by our companies, but in many cases it may not be sufficient coverage. So it's always important to know exactly what you're covered for, and then if it's not enough, then you can look up some additional coverage on the side. So I wanted to give just first a quick example to put a better picture on it. This is Amy, who's an account manager in a startup. So she is not offered a health insurance by her company, and being young and healthy, she just looked for an individual plan for herself with very limited inpatient coverage and repatriation service. So basically, this is what I've seen happen quite often here in China. A lot of us, we rely on, oh, if anything happens to me, I can always go back to my home country and be treated there. So unfortunately for her, a rare form of breast cancer was found, and then she was forced to go back to Australia since the cover that she needed was not covered by her local policy in China, right? A very limited coverage that she had. So in that case, you know, with the COVID situation, then she gets stuck in Australia and she cannot come back. And this is something that, you know, is in not even the worst case scenario. I think we've all seen sometimes of those unfortunate cases in WeChat or so, where people are totally unprotected and they get stuck up in a hospital with an absurd amount that they need to pay and so on. So what I want to do is give a quick guideline for those who are interested in knowing more about insurance. They want to get insured, but they don't know where to start, right? So what I did is I did a quick graphic here that helps you to establish your priorities. So we have at the very base of the pyramid, you have the inpatient or hospitalization treatment, which is what every single expat, in my opinion, should have covered. So this includes any major illness or surgery or any accident that can lead you to be hospitalized, right? So these are all the major costs that could happen to you, and this is why this is so important that any insurance policy will at least cover this. So on a second level, you have the outpatient coverage, which is more of the minor illness, and is most frequently to happen to you is when you catch a cold, when you twist an ankle or so, and you need to go to the hospital, but you just get a consultation, get some medicine, and go back home, and you don't really need to stay there. So this is important to have, but it's not really mandatory. So it's more if you really want to have a more comprehensive coverage. Then dental, maternity are some additional benefits that you can have because they normally involve really high costs, but they're not really necessary. So you normally only seek for this if you know that you will be receiving this type of treatment. So that's why it goes on a third level. And then optical wellness, I consider it at the very end as the least important type of coverage, because it's more of a preventative care in terms of wellness. And then in optical, because it generally doesn't involve really high costs. So in most cases, even you can afford it out of your own pocket. So this is what I consider the most important. It will be inpatient and outpatient, and then from then on, you can move on to the optional type of benefits. So I won't be going too much in depth in this slide, but I just will leave it here so anyone can see it afterwards if they pause the video. Some important factors to consider: area of cover, the hospitals where you want to receive coverage, some deductibles or co-payments, and then just the annual increase that your policy will have over the long run. So going back to the point on what we learned from 2020, obviously COVID changed the whole situation. So there are some things that changed that are important to note. From the insurer's perspective, it's important to know that COVID is just treated as any other condition. So there is no COVID insurance, there is no specific product for COVID. It will just be treated by insurers as if it's inpatient or outpatient, depending on the type of treatment that it is, right? So on a second point, the test can be covered if it's requested by a doctor. So for those of you who are covered, if you have symptoms and it's recommended by a doctor, you can have that covered. And the vaccine also will be covered if it falls within the benefits that your policy covers. So more from the insurance perspective, obviously it created new challenges for people that were not prepared. And coming back to that example that I gave, it's important to know that the repatriation benefits cannot just be activated whenever you want. And not only for the travel restriction sides, but also, when you, if you decide that you want to go back to your home country to be treated, it's not always up to you, and it's always a medically decision that has to be made. So this is important to consider. That's why I put it here. And then last, I think this is the most important point that I can bring up is just how important it is to have a well thought and localized medical coverage. Yes, you can have an excellent healthcare system back in your home country, but it is important to be covered where you are, because you don't know whether you will be able to move back home, and it's always important to have a good coverage where you are spending most of your time. Just to jump really quickly and give a few examples, just to wrap it up. Here you can see an essential plan, which is the first row that you can see there. It will be what will be considered the most essential that you will need. It can range for a person around 35-year-old living in China around $1,000 to $2,000. Then if you are a more comprehensive coverage that also covers the consultation side, it will be about double the price. And then if you really want to have a super well covered plan, then you can see it goes between 3,000 and 5,000. Or maternity, you will add up a little bit more if you need that type of service. So these slides I will share later on with you, Will. I believe you will be sharing it with the people at the web attending the webinar. But here is my contact information for those of you who want to have a more personalized advice, or if you want me to take a look into your policy, you don't know what you exactly have. So I'll be happy to assist you with it and explain to you in more depth.
Excellent, thank you, Ricardo. And we'll come back to you, I'm sure, with more questions in a bit. And of course, yeah, on that we will share these slides around as well for people to look into more detail. So Armando, if you just want to start sharing your screen. And so Armando works with us at deVere China. He is a wealth consultant here at deVere, but he's also the founder of Financially Fit Club. And a big part of everything that he does, which fits quite nicely with the theme today, is actually not only is he focusing on people's wealth, but he also focuses largely on people's health as well, staying fit and lots of exercise. So with that, Armando, I will hand over to you.
Yeah, thank you for the introduction. And yeah, so as you already mentioned, and as Will already mentioned, my name is Armando, or most people also call me Chiu, which is my last name. I'm also work at the deVere China group and in Shanghai, also based in Shanghai, like Ricardo and Will. And I'm a financial planner. I created also my brand, which is the Financially Fit Club, as a way to express and share content on financial planning in a more approachable way, try to make it more simple. But today we'll focus on something which is very important, which is aligned to this topic of how to be better prepared for the unexpected elements, because we all know that 2020 was, or the year of the rat, was a year with many different events. Of course, the obvious one we already know, which was COVID-19, but that was not the only thing. What was unexpected, we had also markets going crazy at the beginning of the year, in March, dropping like 30%, and after that going to the moon and going to historic highs. That's another aspect of the unexpectedness of 2020. And also there could be also unexpected areas in your personal life. There's people who continue, the life goes on and then continue planning. Maybe they have or they're expecting a child, or unfortunately also some other people unexpectedly got ill or even pass away. So as we know, life goes on and is full of unexpected elements. So the main question of this topic of how to be better prepared, or what are the tools or financial tools for our personal financial planning to be better or to be ready for these things that life throws at us, and so we can better tackle them in a most efficient way. In order to explain that, we need to go back to basics. And same like Ricardo, I'm also sharing a pyramid, not as pretty as his, but it's also the financial pyramid. Because why a pyramid? I think is because it's a very specific form that you need to start from the basics, which is the foundation. You need to have a strong foundation before you move to the next level. And same like in medical insurance, for financial planning, you also need to start from the basic structure, which is the protection part, which is actually the whole topic of today. And actually, you're gonna see that there's many things aligned between what he says, what I say, and what the next speaker will talk about. But let's just briefly go through the 3 layers of them, which is, as you already know, protection. After you have a strong foundation, then you can move to the next level, which is planning for your life goals, which it tends to be planning for your financial freedom, planning to buy a property at some point, or sending your kids to college, and the last part could be the diversification aspect, which is where you start to add some spices and get things a bit more sexy in the financial aspect. But most of the people, or not, I wouldn't say most of the people, many times mistakes happen when you focus first on this part of the pyramid. When you want to start with the sexy part without having a protection. And what goes into that sexy aspect of the diversification? Everything you can see online, like having or investing in GameStop, or having cryptocurrency, or choosing individual stocks, which are fine. It could be part of your whole planning, but you need to start with the basic, which is having a protection in your whole structure. So let's break it down. What is this protection? What are the elements in this? So there are basically 3 things, which is having a life cover, having medical insurance, which already Ricardo explained, and the one I'm gonna explain a bit further, which is a financial safety net or an emergency fund, however you wanna call it. Once you have these 3 things, then you can move to the next level and start building the rest of your pyramid. But you shouldn't start doing the others without having a strong foundation or this protection layer. So let's talk about this safety net, because we all know we should have savings, especially since 2020. We know, I don't know if you experienced losing your jobs, hopefully you didn't, but probably some of your, someone of your family back home, they may experience this. And if they didn't have enough savings to cover the basic needs, they probably struggle. So in order to be in a better position, we need to have enough to cover our basic needs. The list that I include here, it may vary from person to person, depends on your own situation, but most of the times it will cover having enough for housing, for food, for your medical insurance. And then the last 2 depends on your own circumstances. If you have liabilities, probably you still need to pay them. If you have kids, probably you still need to pay for their education or other things. But those are like the main things that you need to consider. So the first step for you is to calculate how much these 3 elements of the first list, or even the 5 if it applies to you, how much do you need to spend on a monthly basis? Have this number. And now I'm going to explain, because the important thing is to define what's a good enough safety net or a good enough emergency fund. And again, it depends on your own circumstances, because it's not the same someone who, as you can see in this slide, someone who has no kids and is a 30-year-old just starting their career versus someone with 2 or 3 children that rely on their salary. So as a basic framework, if you have no dependents, then you can have at least 3 times that amount up to 6 months. So let's say that amount is 10,000 yuan per month, that you know with 10,000 you are okay to live for a month, then minimum 30,000 you will need up to 60. But if you have dependents, then in this case, since it's not just you, it's more people relying on your income, then you need at least 6 up to 12 months. Also depends on your age. It could be, even though maybe your children are no longer dependent on you, but because of how the job market is, and it may be, or it may take a bit longer to get another income, you could also take this approach of having minimum 6 and up to 12 months. So think about your own situation. If there's anything that you remember from my talk, it should be this one, like how much should be enough. If for whatever reason, right now you have less than this amount that is suggested, then that should be your focus, number 1. Or if you have more than that, then that's also a warning sign that you are cash heavy, and then you should be focusing on moving on to the next layer because you already have this well covered. And now one question that I get a lot is where to keep that amount or that emergency fund. And there's not just a straight answer, because it depends again. But 3 of the main things that you can think of is, first of all, well, most of us in this webinar probably live in China. So that doesn't mean that you need all your emergency fund here in China or all of it outside. You can even split it, because maybe if you think, oh, if I lose my job, I still want to stay in China, then probably you still want to keep some of that savings in here. But if you're thinking at some point I may need to go back, if you have everything here, we know it's not that straightforward to repatriate renminbi. So think of that before you decide to put a big chunk of money in one place or another. So that's about access. Also needs to be safe. This one, you shouldn't invest it. You should keep it in a very safe amount, because you always want to make sure that you have that amount. Even if the market drops, you still want to have that number for any emergency that happens. But if you do happen to find something that helps you to at least not lose value on that amount, it tends to be something like money market funds that is usually not going to give you great returns, but at least is 1-2%. It's better than zero. If you do happen to find something with those elements and that is also very easy to access, then for sure go for it and take advantage of that. So those are the three main things to consider when you decide where to keep your emergency fund. And that's it for me. I mean, it's all about having good enough protection. We already covered the medical protection by Ricardo. I talk about the financial safety net. And that's why I mentioned this pyramid is all connected between the three speakers from today. So if you have any questions, we can move on onto the Q&A later on. But thank you for your time and have a good evening.
Excellent. Thank you, Armando. Brilliant. And really gives us a good picture of where we're at and how important it is, this protection level. So yeah, if you want to share your screen, Rich, there he is. Rich is in Hong Kong, works for RL360, and he's been working in the financial services industry for over 15 years, starting off at HSBC and is now transitioned to the Director of Sales at RL360. So over to you, Rich.
Thanks, Will. Trust everybody's okay. I've got the, pardon the pun, but the graveyard slot, which is quite fitting because I'm going to be talking about life cover. Just before I start, just a thanks to Will for allowing me to do this. It's quite interesting with the COVID being able to travel, well, not being able to travel, but obviously we've all adapted and picked up on Zoom, so we can still get to see clients and brokers and give sort of Zooms like this and training like this, which is really valuable to out in the market. What have I learned, or what have we learned as a company from 2019, 2020, especially COVID? Well, I think two things. Firstly, life cover has become very, very much prominent in most, if not all, financial advisors' toolkits now. We've seen an uptake in business, at least between 80 to 100% on sort of life cover cases that we've done over the last 2 years. And I think that's solely down to two things. The first thing is that with COVID, people are spending more time at home. They're spending more time with their children. They're spending more time reviewing finances. And yes, we're all working at home, but we do tend to have a few more coffee breaks, I'm sure, in your living rooms. But we have seen a lot of more people take their financial, especially life side of it, where you need a little bit more time to review it and think about it, but really take that conscious look at whether you are fully covered for family protection, which is, as Chiu mentioned, is the starting block of any sort of financial planning or financial process. The second thing, sadly, is death. We don't like to speak about death, but sadly, most, if not all of us, have heard about a death or some death via the news or personally, sadly, and it does make you think. And when anything like that happens, life cover does become the forefront of your thought process, especially if it's a family member or someone close. So certainly for us, it sounds like we've taken advantage, but we are a life company. We do have a life product, and that's what we're there for. But I also think it's important to make sure that financial advice is at the forefront of why you decide to take life cover out. So I'm also going to cover off a little bit of the process. Use a few stats from a couple of decades and see how they've changed up until now. We'll talk a little bit about is health and wealth correlated. We'll look a little bit about sort of premium levels and how age affects that. And we'll also start with a little bit of something to think about. So Just a starting point. You don't need to answer the question. Well, you can always stick the answer if you, or your point of view in the question box, so we could maybe Will can read a few out. But if you were Neil Armstrong and the crew of the Apollo 11, would you have taken out life assurance? And obviously that's pre going to the moon. So have a think about that, and we'll come back to that in the end. This slide's obviously not good for all the people who think there's a flat Earth either. There we go. So let's have a look at some global stats. So according to quite a big international life company out there, more than 800,000 babies born in UK 2013. Over a third of them are expected to live to the age of 100. Well, we're not in 2013 anymore. We're obviously in 2021. So those stats have obviously grown. But the point of that stat is that we're living longer. And what that does for things like financial barriers and what you have as a safety net, as Chiu mentioned, and what you need as life cover, it exponentially makes that grow because we're just on the planet longer, we're doing more things, we're spending more. But as we do live longer, what effect that has on life premiums is it actually reduces them because less people are dying. So that's quite a good thing that we are actually, in fact, living longer. Hospitals are better, medical care is better. So that's certainly a positive. That leads into 65% of worldwide deaths are attributed to lifestyle. I think we already know that. I mean, nutrition, exercise, smoking, alcohol, they're all the obvious ones. And they are noted by the Oxford Health Alliance there. But we are getting healthier. If I look at myself, and I think if you look next to each other, if you sat with somebody or look at your local park, you look at your employer, they're all striving to make you a lot more healthier. Less people smoke, nutrition is better. I mean, you've got people delivering your food, but that food tends to be a little bit more healthier, I think, even though it's a little bit healthier to go get it. But anyway, but we're certainly healthier. Big medical insurance companies, health insurance companies, AIA, Manulife, the big boys out there, they're all promoting how many steps you're doing, how many lunges you're doing, how much you're running. They're tracking this by watches that you wear on your wrist and things like that. And this all feeds back in to proving that actually as a lifestyle or a race of people, we are becoming, especially in the first world, we're becoming a lot more healthier on the whole. People still smoke and we still drink and we enjoy to do that, I suppose, but we are getting a lot more healthier. And in effect, that's reducing life cover premiums because again, and I assume medical premiums as well, because the healthier you are, the less need you have. You still have a need for that product and that coverage, but it's less likely. Obviously, death is more likely because death and taxes is always going to be likely. But the fact is that it reduces the cost of life cover and insurances. So we're moving in the right direction. So if that's the case, currently about 60 million American households are either underinsured or uninsured, industry experts say. So why do more families have why do more families or less families have life cover in place? So let's have a look at that. The first thing to know is that life cover is somewhat, it is an intangible asset. You can't see it, you can't touch it. And therefore, when it comes to putting in place life cover, it's one of those things where you have to be, in a sense, sold to. So it becomes quite difficult. So there is times where people are cancel premiums, can't afford premiums, decide they don't need it. They're all the points on the left-hand side there. And that's apparent because they've either felt like they've been sold to or they felt like they didn't understand why they had it, and maybe 3 or 4 years down the line cancel it. And that's become quite apparent throughout the industry over sort of the 80s and 90s, especially when you got, if anybody's from the UK on the call, people knocking on your door selling you life assurance, and it used to happen quite a lot. Nowadays, what you have is you've got very thorough financial advisors, and just looking at the guys at deVere and what Chiu was saying, previously, life cover is massively important now, but there is still reasons why we may not be covered. What I'll do is I'll cover off the 3 in bold in grey there, and we'll finish on the red one. And these are things that I hear across the Asian markets that I cover. When I say I hear this from financial advisors out there when they're actually advising clients very well, but they tend to come across these responses. And it always makes me think on why people would do that and why say these things. So the first one is we have enough savings. We talked about families now, obviously, and that's fair enough if you've got a huge amount of savings. But if you're in a period of your life between 30 and maybe 50, where you're growing your finances, your job, your family, etc., the likelihood is that you're actually still saving. And it always quite amazes me that people are happy to put aside something that is tangible, like money, which makes sense because they can see a goal of their retirement or their children's university, but they don't have life cover, which in essence, if something happened to them, it would take all their savings to get them to that point, which wouldn't be really why they've put those savings aside. And if they've just started saving if something happens to them, then obviously they haven't got anything to show for it. So I think the point there is when you're looking at your savings, they have to be treated as that. Now, don't get me wrong, if you've got huge amounts of savings and you don't need life cover, that's apparent, and that will become apparent quite quickly when you're speaking to your financial advisor. But certainly savings should be, or life cover, or the premium element of life cover should be held in the same regard as someone putting aside a form of savings after their emergency fund, as Chiu mentioned. The other thing that people tend to say is I have company death in service benefit. Death in service benefit tends to be 3 or 4 times salary if you're lucky these days, and that's a really good benefit to have. And most international companies will provide that. I know I have it with RL and certainly had it with HSBC. But if I happen to move into a different job that doesn't have it, or decided to start my own company, you're suddenly going from a company benefit, which is very high value, to having nothing. If you're now in the realms of 40, 45, 50, you're then looking at life cover to protect your family at a far higher premium. So again, what I tend to say to advisors when they talk to me about these sort of responses is that death in service benefit is just that. It is a benefit. It should be over and above what you plan to put in place to cover someone's family. And what I mean by that is basically you should look at covering mortgages, children's school fees, etc., and then use the company death in service benefit as what it's there for, and it's a benefit. Because in the end of the day, 4 times salary or 3 times salary is only going to give your children 3 years of your income. What do they do after that? So by relying on a death in service benefit, and some people do, it's quite dangerous to do that. The final point I'm going to touch upon is only the breadwinner needs cover. I always find this quite interesting, a bit like the death in service benefit, I suppose. Breadwinner, whether that's man or woman, a non-breadwinner, we always seem to think that, the breadwinner will go, well, I'll just cover me because that's all we need. I earn the money, blah, 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 blah. I use a man's voice there because usually not the breadwinner is not usually a man, but that's usually what they say. But I'm the breadwinner, so I don't really need, we don't need to cover a wife or husband that's not working. Well, I always tend to sort of home in on the heartstrings there a little bit, because we live abroad. We live in countries that are not our home country. The likelihood is that if anything were to happen, and again, it's not great to talk about, but if partner dies, leaving you to look after 2 children, the likelihood is you might be working 50, 60, 70 hours a week and earning a good salary, but would you want to continue to do that if you've just had a recent bereavement in your family, especially if someone as close as wife or husband? The answer is probably not. The only really reason why someone would say I'm the breadwinner, so let's just cover me, is because they're really just being a little bit tight. I think to one of the better term, I suppose. But if you sit down with a financial advisor, like the guys at deVere, they're certainly going to home in on the fact that life cover is all about what you want at the end of the day covered in case something disastrous happens to you in your life. And you've got to ask the question, would you want to work? Would you want to continue paying a mortgage? More importantly, would you want to spend time with children, etc.? So again, these sort of negatives towards why people don't have life cover, they need to be overcome. And the final point in red is we may not know how much cover we need. And I think that sort of ties all of these sort of responses together, because it really is important for Wills, the Chius of this world to really sit down with their clients, and I know they do, because I know we have a lot of life cover cases from these guys, to really talk you through it. And I think long gone are the days where people say, you know, you need 10 times this and 8 times your salary as a guideline. Well, actually, when it comes to financial planning now, you really need to sit down with clients and talk through their whole situation. And it doesn't stop there, because different ages, different financial levels, different number of children creates different needs. So it's something that should always be reviewed. And again, we would suggest reviewing this, you know, every year. You may not need to change anything, but certainly to keep that review going is massively important when it comes to covering your family. Last point on there, just if you didn't know, if you may move countries. Obviously, RL has their life cover. It's internationally mobile. If you do have life cover, say if you're from the UK and you've moved abroad, I would just check the small print to make sure that it would cover you while you're abroad. Some don't. I'm not saying go out and cancel it, certainly not, until you've checked, but certainly you don't want to be paying premiums if you're not going to benefit from it. You'd sort of be dead, so someone else will benefit from it, but anyway. Okay, so is health and wealth correlated? Let's do the last few slides. So I do a presentation on this. I think I did it for Will and the deVere guys, I think. But when I'm next over, or when I can next fly to China, the actual presentation is about 45 minutes long, and it's quite outgoing. There's a lot of good stuff in there, a lot of interaction. So if Will wants to organize me to do that when we can finally channel, I'm more than happy to. But this is just a bit of an amalgamation of it all. And basically what it says is, the question is health and wealth correlated? Some people will say yes, some people will say no. But it really does make you think about what stage of life you're in and what you have to look for. For example, so I'll just pick one example, because obviously we're slightly out of time here. If I think back to my parents, sort of when I'm 42, so when they had me when they were in their 20s, most people quite a while ago had children, so the 80s, 90s, had children early, between ages of 20 and early 30s. And they had a real sort of timeline for their finances. So have children, save for school fees or buying them the first house or something like that. Because you've done that, you put a bit of life cover in place. When they get to 18, they move on, and then you start to look at your pension planning. So you start saving for your retirement. And if you look, or if you can visualize, if you are visual people out there, you have 3 circles. So you've got your starting point, your midlife, and then you towards your sort of retirement. But there isn't a crossover. The circles don't cross over. If you now look towards where we're sort of entering in life now, especially in our modern days, where health is a big thing. And we talk about health, but we talk about health as in body, so fitness. So we're living longer, as I mentioned before, but also sort of mental health. So people are wanting to travel for work. They want more holiday travel. They want to do things later on in life. They want to have children later in life, more to the point. It's not unknown now for women to have children beyond 40, whereas previously it may be classed as dangerous. We're having our first child, and my wife's 40. Okay, there's minor risks that you've got to be careful of, but in reality, our lives now compared to our parents and parents before that are shifting. But what that's doing in correlation to wealth is actually crossing over the barriers or the circles, if you like. So where now I would be thinking about savings, and perhaps I've saved a little bit, but I've also traveled a bit and spent a bit and had a few beers in Wan Chai, if you know Hong Kong. But put a little bit aside, I've now got to start thinking about school fees. But really, I want to retire at 55 if I'm lucky, or 60. So somewhat I've got to start thinking about pensions, but also I've got to start covering myself in case anything happened to me, or my wife has to cover in case anything happens to me. So suddenly you're starting to think about the crossover or the correlation between all our outgoings at one point, rather than spreading them over your lifetime. So it's a real concern going forward for financial planning that people are actually making best use of their ingoings and outgoings. And certainly from an advice point of view, life cover, as much as people love to save and see it growing, life cover is one, if not the most important starting block for that. So is health and wealth correlated? I'll let you decide. And if you ever get to see me do the proper presentation, don't throw fruit and veg at me. Final slide, the earlier the better. So pretty obvious. But the earlier you start, I'm not suggesting if you're 22, you'd start taking out life cover. Maybe you do, maybe you are very smart. But certainly if you look at these 4 or 3 barriers, age 30, 40 and 50, same sum assured. Again, as you get older, your sum assured could either increase or decrease. The more money you have. If from the UK, you might create yourself an inheritance tax, you might need more, you might sell things off and you might not need that. You might have children at later life. There's different things you can discuss. But certainly from a sum assured point of view, 500,000. The term I put whole of life, term premiums are cheaper, but this just gives you a good idea. But what you do recognize here is certainly the increase from a 30-year-old up to a 50-year-old on premium levels. And we do get people of that age coming to us and taking out life insurance and wishing they'd done it earlier, because now you might be earning a lot more at 50, but you may not be, but you certainly will still have that same need. So £303 in this circumstance or this example is certainly better than 762. But again, I'll leave that to you guys to discuss with Will and Chiu and the deVere guys. So what did you decide? Well, it doesn't take a rocket scientist. Did the Apollo 11 crew decide to put life cover in place? Well, they tried, sadly, but they do a pretty extreme job. So like any life insurance company, especially one I work for, they certainly wouldn't be covering someone going to the moon. They might do in the future if Elon Musk has anything to do with it. So what they had to do is they had to do some life insurance stroke autographs, which they sold off and then put in a pot in case anything happened to them, so it go to the families. They didn't need them, thankfully, and they got to the moon, which is good, or some say they did, some say they don't. But the point here is they knew they were going into something very, very dangerous, so wanted to make sure their families are okay. The point is that it doesn't really matter what job. Obviously, your family comes first, and what you leave behind is certainly massively important, and it will become more important as your financial size grows, I suppose, and your wealth and your family, etc. So really do give it some thought. Been great to present. I hope you've enjoyed some of the points. And back over to Will.
Great, thank you so much, Rich. So if you just want to stop sharing there, and if Armando and Ricardo want to turn on your cameras, we've got a bit of time for a few questions. Hopefully everybody can see us as a gallery view. In theory we can, so I hope that'll go well. Yeah, excellent presentations from all. Really very good. And I've got some questions written down. If you want to throw in some questions, please either get them to the chat box or into the Q&A. We do have a little bit of time to do that. First of all, I wanted to start with medical insurance. Actually, before I do that, any of the panelists as well, if you have questions for each other, please feel free to jump in and ask those along the way as well. Get a bit of interaction. But first of all, I wanted to go over to you, Ricardo. Obviously, COVID last year. Did we see any increase in premiums because of COVID? Because, I mean, presumably people are accessing medical insurance more.
Yeah, I would say, I mean, naturally, every year insurers will increase the premiums. This is based on the inflation of medical costs. So every year there's a natural increase that it varies between, I would say, 4 to 10% in average. But I would say that surprisingly, insurers didn't increase much more than that. So it was normal to the standards between 5-6% for most insurers. So it was actually not as impactful as in terms of the premium increase.
Okay, that's good to know. So, I mean, one thing I wanted to ask actually is a question I had for my client, which is not something we'd really thought about in great detail before. So if somebody is retiring abroad, and you did bring it up about people not being able to go back to home countries or relying on a home country healthcare system, what would somebody retiring abroad in China or in Asia where there isn't that healthcare system to support them, what would they need to do to prepare, or what should they be aware of?
Yeah, so what I will always recommend, and I do for some of these clients that are on a later stage where they're about to retire, they're looking to retire, maybe here in China, maybe somewhere else in Asia, as you said, is that in many cases, the priority is always to keep a plan that covers hospitalization, as I told before. So what I recommend is to do a forecast for the next 5, 10, 15, 20 years, because this is most likely people that are going to stop receiving a constant income, and they have a savings that they need to plan for the next 15, 20 years when wherever they're going to be spending the rest of their life. So I recommend to ask your advisor to prepare a forecast so you can see whether your current plan that you have, if you have any, or which is the best plan that you can keep for the long term. So which plan is going to be the best in 10 years, in 15, or in 20 years from now, and that you can actually make a plan that you can keep for the long run. And because what you really don't want to have is to get a coverage at 60 that you're going to stop at 70 when your risk is even higher, right? So you want to get a plan that you can keep for the long run, for as long as you need. So that's what I would advise, to get a really good forecast for the next 15, 20 years.
Excellent. And then Armando, I guess that builds into preparing for those costs financially as well. So making sure that there's a plan in place to cover those costs for medical insurance.
Yeah, absolutely. Of course, that's a different topic. That's not about the protection layer of the pyramid that goes into your life plans until the next layer of what you need to prepare when you're thinking about retirement, because it happens a lot when we're talking with different clients, and you can also confirm it with me that when you ask people about how do you picture yourself when you're 55, 60, how much do you think you're going to spend? And most people underestimate the real expenses because they say, well, right now I spend X amount of money. If I keep the same lifestyle, then that's great. Or maybe some people, they want to upgrade it, but sometimes we forget about there's extra costs that we don't have right now, but we may need them in the future. Like right now, maybe my medical insurance, me as a just 30-year-old, cost me X amount. When I'm 60, I'm still gonna need to pay that, but it's not gonna cost me what I'm paying right now. And even myself, I could even forget about it. So we really need to remember these things are also very important, and we need to consider it when we're planning for our life things in the future.
Yeah, absolutely. And yeah, it's very difficult to project that far ahead. So, I mean, on that as well, I mean, you spoke about making sure you get everything in place, and you know, it's very, you know, we all like to have that plan, right? We need to say, okay, we must have that foundation in place. If we're honest, most won't wait until they've got their full protection in place before they start doing some of the more interesting and sexy stuff in terms of investing. So, I mean, how would you help guide people? And you know, there's the official financial advice, and then there's a bit of the real world, right? So how would you help guide people in that sense to say, okay, maybe it's percentages of income, or thinking about it mentally? How do you tend to guide your clients in that sense?
Yeah, so yeah, it's true. There's the theory and what people actually do, right? So definitely in my case, I tell people, well, if you have liabilities and also you don't have a emergency fund, we should focus on how to mitigate these because those are the ones that are priorities as well. Also, however, you need to divide your budget because everyone knows what's happening with their income, well, hopefully, but then you need to do a split of and what's the budget I'm going to allocate towards my financial future, whether that's covering my expenses or covering something else, and then try to divide it, because most people try to focus on one thing at a time, but sometimes you can tackle multiple things. So think what is the most thing in danger you are right now, and then if you have nothing in your protection layer, you're starting from scratch, then it may be also based on your budget, it may be not that easy to try to cover the three of them at the same time. Then I would say, what's priority for your personal situation? Do you have someone who relies on you? Is your company giving you at least something really basic? If they're giving you something super basic, maybe you can then start to move towards something that you don't have yet, and then come back to that one. That doesn't mean you are covered, as Ricardo already mentioned. That means at least you have something, but then you still need to revise it because that's still important. You need to think of what really matters to you, but at the end of the day, it depends a lot on case by case.
And I guess what some people might do, this would probably be more towards you, Rich, as well, is actually starting off, well, actually in all areas really, but starting off with something. So I mean, do you see many people coming in and say, okay, well, yes, I need life insurance, I need life cover, but realistically, I can't afford to cover for what I'm going to need in 30 years' time. Let's have something in place, you know, in the immediate situation, and then I can increase that later on. Do many people do that?
I think so. I think the key point there is that when you sit down with yourself or Armando or any of the guys at deVere, you look at a client's ingoings and outgoings, and it is down to what they can afford. You know, you're always, from an advice, my personal view is that you're always going to advise what a client would need for life protection. You know, when you've looked at, like Chiu said, the ingoings and outgoings, mortgages, debt, that kind of stuff, what they want to make sure, how long for. If a client then can't afford that, then obviously you've got to work down. It's just not a given not to have any life insurance, because it's dangerous to do that. What you would do, or what people tend to do out in the market, is they will then work down to an affordability level for the client. And as you say, some life cover is better than none, for sure. There is no doubt. And as salaries go up and promotions come along and more money's involved, it's for the financial advisors of this world, the deVeres of this world, to re-review that. And if that needs to be increased at a later time, then that's perfect. You know, absolutely perfect.
Yeah, it comes across the whole thing, doesn't it? I mean, as you develop, your salary goes up, your commitments go up, your medical insurance requirements go up. You have a need, as Armando was saying, about the emergency fund, that amount needs to go up as well, and probably your life insurance needs to go up. So it's very much, as you say, the reviewing process as well is just as important. It's not a one-stop shop, right, I'm sorted for the rest of my life. Got to keep reviewing it across.
Not everybody, so take the UK for example, UK regulated by the FCA. Not everybody can afford life cover, but when a financial advisor recommends someone to take life cover, they actually have to, I mean, there's numerous amount of documents now you have to fill in, which is the regulation side, but the advice has to be countersigned by the client to say they are aware that they've been advised life cover, but either they can't afford it or they just choose not to take it. Because in reality, if someone then passes away and you haven't recommended it, it could be an issue. So it's a big part of financial planning, but it has to fall in with the client's affordability for sure.
Absolutely. We are a little bit tight on time, guys. What I do want to do, we had a question in our webinar group, and as we've got Rich, you got you one from RS60, who we work with in numerous different ways, not just life insurance. So Sarah's asked, now that the UK is not legally in the Eurozone, will this in any way have legal implications on a Crown dependency jurisdiction like the Isle of Man immediately and in future years?
Well, I'm no lawyer. I will caveat that. It's a good question. I think, first of all, you've got to look at what Crown dependency means, because for the Isle of Man, a Crown dependency, the Isle of Man has its own government, monetary authority, own regulations, etc., etc. When you're a Crown dependency, you rely on the UK primarily for import-export agreements from different countries, military support, and obviously financial support if required. But in reality, the Isle of Man is limited on that financial support because of how well it's run. Jersey is very much the same. The EU, the Isle of Man has own separate agreements with the EU for certain things, and they will stand, but it's actually not anything to do with the financial side. So in regards to any policyholders with RO360 or any life assurance or investment company based on the Isle of Man, nothing will be changed in regards to the regulation, the structure, and the security of the Isle of Man. And as you know, it's a AAA rated financial institution as a country, so very, very secure and very, very internationally minded. But that said, I think the breakup with the UK and the EU will eventually affect everybody at some point if we're from there or connected to it. So we'll just have to wait and see, but not anything that would create anything to worry about for sure.
Yeah, no, that's good to hear. It's good, reassuring for a lot of our clients that have got investments with RO360 and others that are involved there. Excellent, thank you. So lots of information there for all. And so what we want to do as well is we've kindly, each presenter has offered to share their slides that we can get out there as well, but also a little bit of extra information that we can get out there to each of you if you're interested in any specific topic or would like to speak to them directly. So what I'm going to do is I'm just going to put a poll up. and just let us know. You can choose one or multiple options there. If you'd like more information on medical insurance, building an emergency fund, or sort of financial advice in general, or life insurance, just pop that in there and we'll make sure the right information has got out to you. We also have a webinar group, which I did briefly mention with the question. Hopefully most of you are in that by now. If you're not, please reply to the email where you had the registration link in there, and we'll make sure you're put into that webinar group. We have a few chats in there, some few surveys, so there's lots of good information in there. And we want to know also as well about webinars upcoming in this year, what you want to see. We're going to focus more on you this year. We're going to try and get you involved, interactive as well in these webinars. We want to make sure that it's all about you rather than us just presenting at you. So thank you so much. Thank you, Richard. Thank you, Armando. And thank you, Ricardo, for your excellent presentations and for answering the questions. Thank you all for attending. I hope you enjoyed the webinar and have a great evening.
Thank you, Will. Thank you for hosting.
Thanks, everybody.
Thank you. Bye-bye.